So, dear Professor Manti, caro Mario, dear Professor Zironi, Professor Pavesi, Mr. Giuliani, I'm very pleased to see old friends from Italy, Vittorio Grilli, Vincenzo Lavia, ladies and gentlemen. I must confess I was a bit surprised when my assistant told me that Professor Monti would like to talk to me on the phone. I thought when the former Italian Prime Minister wanted to know something from the European Central Bank, why didn't he call the other Super Mario, the President of France? But as a trained, polite civil servant, I returned the call, of course, immediately. And I must confess the surprise and the joy were tremendous when he informed me about the decision that the Bocconi University has granted me the award to be the alumnus of this year. I really feel honored. I'm very grateful to receive this award. And I see it as an obligation for the future at the same time. And I would really like to thank Mario Monti for his very kind introduction. It's really generous to say of him that he knew me since the mid of the 90s, somewhere in the German Treasury. I respect there was some asymmetry in this relationship. I know you rather than you know me, but that's very kind. So my choice to study, to do an MBA here at Bocconi, it had probably something to do with the old German craving for Italy. If such a thing exists as an emotional relationship between people, I think this is true for Germans and Italians. That goes back to the old times when Goethe travels to Italy, to the quest for Arcadia. And on the other hand, the long-standing Italian admiration for German efficiency, our sense of order. And the time I spent here at Bocconi, I look at them back in great fondness. It was really a privilege to study here at one of the great seats of learning in Italy and in Europe. And I see this time as a period that really helped me to forge my views that later served me as a European civil servant and policymaker. When I came here, I was 25 years old. I really come from northern Germany, and I had no experience about other cultures, despite the Danish one. And this all changed here at Bocconi. This was a truly international environment. We were students from 26 different countries, working side to side. I shared my flat with 2 Turkish students. And all these experiences have taught me some lessons. The first lesson is the value of cooperation. What we learned here at Bocconi is that, on average, teams achieve better results than individuals. Only brilliant individuals are better than groups, but very few of us are brilliant. So the work we had to do always were conducted as a group, and we only got 1 mark for this. So we had to stand or to fall all together. And the second lesson was the value of diversity. I brought with me my German cultures, others brought their cultures. But none was better or worse. In fact, the diversity simply provided us for an opportunity for better learning. And I think it's not hard to see how these values, diversity and cooperation, helped me in my professional life. in particular when tackling the crisis. Because in the euro area, ultimately, we also only get one mark. We cannot have a stable monetary union where some succeed and others fail. We have to advance together. But we also need diversity in the euro area. There is no single economic model that fits us all. This is why we have to learn from each other about which kind of policies best produce jobs, increase our growth potential, secure equality of opportunity, as well as participation. And in keeping with these items, I would like to use the opportunity this evening to lay out a pragmatic vision for combining diversity and cooperation in the euro area, or put it differently, for building a more integrated monetary and economic union that respects our differences. And I would like to present to you what I see the rationale for a banking union, and I would sketch some first ideas about a fiscal union in the euro area in the medium term. And my focus is the euro area because this, for me, is the core of future European integration, but it's an open call. Who is willing and able to join is welcome. For reasons of time, I will not tackle the economic union, which is an essential part to complete the EMU, and I will not touch upon political union without downplaying its importance. Because progress, for example, in the fiscal union can only be achieved if we make progress on the political union at the same time. Because it's true what Mario Monti and Sylvie Goulart have written in their recent book, that greater European integration has to be accompanied by greater democracy by the people. And at the end, I will use a few moments to talk about Italy as an example, what needs to be done at the level of member states in Europe. But let me start with the banking union. Because here the problem, in my view, in the past was that we had too little cooperation and too much diversity. We lacked a coherent approach towards financial sector policies in Europe. There is clearly more scope for cooperation today, especially after the crisis, where now preferences, in my view, are more aligned in Europe. We all want banks that are better supervised and that can be resolved at a minimum cost to the taxpayer. And when we try to do this, we do not have to reinvent the wheel. There are elements of the approach of the United States which have worked well and which we can usefully borrow in Europe. These fall into two basic categories. The first one I would call a public banking union. These are federal institutions that deal with the crisis. And second, what I would dub a private banking union. These are integrated financial markets that dissipate the cost of crisis. The key difference between Europe and the US is that banking problems in the US have mainly taken care of at the federal level, while in Europe the responsibility for troubled banking has remained national. And during the crisis in the US, it were federal institutions that stepped into the breach. It was the FDIC who resolved 490 banks using funds that were contributed by a levy from the industry. The US Treasury provided recapitalization support and guarantees through the Troubled Asset Relief Program, TARP. And the Federal Reserve undertook a rigorous stress test determining banks' additional capital needs. And to understand the situation in which we are in Europe, it's worthwhile to make a thought experiment for a second. Imagine that no such federal institutions exist in the US. Imagine that the state of California had to come up with the TARP money for Wells Fargo on its own, instead of the US Treasury. Imagine that the state of New York had to provide the guarantees to Citigroup. How would global financial markets have treated these states? And how would they have treated these banks? So the lesson for the euro area is clear. Federal institutions can prevent local crises from becoming systemic. And in Europe so far, we don't have these federal institutions that can act as shock absorbers. So far, the responsibility for dealing with troubled banks lies exclusively with the individual member states. And the result is, to quote a Financial Times editorial, that national taxpayers subsidize banks implicitly in good times, explicitly in bad times, and up to suicides in a sovereign debt crisis. The crisis has shown in Ireland that problems in domestic banks can overwhelm the fiscal capacity of national sovereigns. But the causality can also be the other way around, as the case of Greece has shown, where fiscal problems have dragged down the banking system. And these countries got caught in a vicious fiscal financial feedback loop, which at the end also can drag down the economy. It can break the internal market, and it can impair our monetary policy conduct. Removing this vicious feedback loop, that is what the banking union is all about. And creating a banking union that is good for the euro, it's good for the internal market, and it's good for the recovery. The banking union is good for the euro because it will help to repair our monetary transmission. It will ensure that ECB's low interest rates will be effectively passed on to the countries that probably need them most. The banking union is good for the internal market because it will help to reverse the significant fragmentation that we have seen so far. And the banking union is good for the recovery because banks will be put on a stronger footing, confidence will improve, and ultimately credit will start to flow again to enterprises at affordable terms. But what are the necessary elements of a banking union? There are two key. A single supervisory mechanism, the SSM, and second, the single resolution mechanism, the SRM. The single supervisory mechanism, the ECB has been tasked to take over the responsibility for this. And we are making good progress on this front, and the SSM should become operational in the last quarter of next year. Before we take on this task, we want to get a clear view what we will be supervising. Therefore, in the coming months, we will undertake a balance sheet assessment, and in my view, the importance of this exercise cannot be overestimated. It's an extraordinary opportunity to rebuild confidence in the banking sector and to promote the long overdue repair of our bank balance sheets, which in turn is a precondition for a sustainable economic recovery. One point needs to be stressed. Credible national backstops must be in place. If not, the credibility of the whole exercise is put at risk, as the outcome will then almost certainly be negatively perceived by market participants. And doing the balance sheet assessment without backstops in place would be a bit like getting on a boat in a rough ride in rough weather conditions and not taking a life jacket on board. Any recapitalization needs, of course, should be first and foremost be covered by the markets. Second, national backstops are the national budgets. And finally, we have a European backstop, the ESM with its existing instruments that is available. And the second key element of a banking union is a single resolution mechanism. This is a European equivalent to the US FDIC. The crisis has shown that simple coordination among member states is being not appropriate to organize the resolution of cross-border banks in an efficient and least cost manner. And this single resolution mechanism again has three elements. A single regulatory framework. This has been established but has not yet entered into force with the Bank Recovery and Resolution Directive. The second element is a single resolution authority, and the third one is single resolution fund, funded by contributions from the industry. The last two elements are currently in the legislative process, and we really strongly support the time frame to have this in place roughly around when the single supervisory mechanism starts place. The private banking union. In the US, they have an integrated financial market which includes as well the banking sector as well as capital markets. In the US, the banking sector has mainly nationwide banks, and this allows them to diversify risks. They can offset losses in one state with gains, at least partly, in other states. In the euro area, the banks have mainly a domestic focus. And second, the US has capital markets that have integrated equity and debt markets, allowing losses from bank failures and corporate insolvencies to disperse across the whole market. While in the euro area, cross-border capital markets are only partially developed, and this means that any negative economic shock is fully concentrated at home. For example, in Germany or in France, equity holdings are 85% domestic. And one should not underestimate the importance of integrated financial markets, because there are some academic papers that show that 2/3 of an economic shock in the US is absorbed via the integrated financial markets. In the euro area, with the launch of the euro, we have encouraged some more private risk-taking between countries, but it remains at much lower levels between euro area states than between US states. And markets are vulnerable, you know this, to fragmentation. And this points to the fact that the private and the public banking union have a significant interdependence. Having a strong set of federal institutions can stop market failures. Similarly, having a single financial market can make the task of federal institutions easy, particularly for resolution, since it allows mergers and takeovers to be part of a resolution strategy. Coming back to the 490 banks that were resolved in the US since the crisis, 450 of them. It had been involved in an instrument that is called purchase and assumption. That means selling a bank to another bank, often located in different states. So the conclusion is simple. Completing the banking union and completing the single financial market goes hand in hand. Let me now turn to fiscal union. And for the fiscal union, finding the right balance between diversity and cooperation is much more difficult, because national preferences on taxing and spending are stronger, and the case for elevating these functions to the European level is much more complex. And there can be no taxation without representation. And this means any shift to a more European fiscal policy must be accompanied by the same level of shift of democratic control to the European level. In order to frame the discussion, I think it's useful to go back to the old taxonomy of fiscal policy that Richard Musgrave has developed. He distinguishes between stabilization, allocation, and distribution. Broadly speaking, stabilization helps to smooth the business cycle. Allocation ensures that resources are used efficiently, and distribution ensures an equitable sharing of income. And which of these functions do we need at the European level, and in what form? Starting with stabilization. There is a long-standing debate about whether a monetary union needs a federal budget to support sound counter-cyclical stabilization. Go back to the Four Presidents report, which suggested that a small fiscal capacity could be used for this purpose. I will not comment on the specific proposal the Four Presidents have made, but it's a question if preferences in Europe up to now are sufficiently aligned to permit it. So I really want to think what is essential for the euro area to function, and especially to think about how having a genuine banking union might change the debate. Because currently in Europe, stabilization takes place through national budgets. And in normal circumstances, there are sufficiently to smooth the cycle. They were only insufficient in some countries during the crisis because they faced one exceptional circumstance, a very large shock from the financial sector. But with a genuine banking union, the risk of this happening again should be lower. First, we expect the SSM to increase the quality of supervision and the assessment of systemic risk. And second, if a financial shock were still to appear, national budgets should be better isolated. The cost of bank sector repair would be shared with the private sector through the single resolution mechanism and a more integrated European financial model. This suggests that national stabilization should be more effective in the future, or to put it differently, the more successful we are in creating a genuine banking union, the less we would need a central bank budget for stabilization purposes. This does not mean that I see no role for a fiscal union for stabilization purposes. We would need a public backstop, namely for the resolution fund, which would be fiscally neutral over the medium term, and in my view the ESM could play this role. And second, we would need an insurance mechanism against tail events that may still arise and endanger euro area financial stability. And here we already have the ESM to act as a lender of last resort to sovereigns. Turning to the allocation function. Here I see a room for a fiscal union that performs an allocation function at the European level. In the literature, this is typically referred to the provision of public goods, and in this context, to use common funds to incentivize structural reforms. I will not discuss this in detail. I think that's a good idea, especially for the euro area, including an own revenue resource. I want to have a focus on a different aspect of allocation. That's taxation. Because differences in taxation regimes create hidden barriers and inefficiencies in the single market. And one aspect of a fiscal union could be to remove this. Different rules for taxing dividends, for example, discourages cross-border investments in equity. Different corporate tax regimes mean companies do not necessarily invest where production is the most efficient, but where they receive the highest after-tax return. The Commission has made some progress in addressing these issues, but overall, the approach, in my view, to tax policy in Europe remains piecemeal. And in this time where growth is stalling, markets are fragmented, I see benefits for greater cooperation that deepens the single market. And one should focus on taxes that have the highest importance for the functioning of the single market: corporate taxation and capital taxation. And a more coherent strategy should be based on 3 prongs. The first is harmonizing tax codes to remove distortions to cross-border activity created by problems like double taxation or different treatment of residents or non-residents. The second is harmonizing the tax basis. A good way forward, in my view, is a common consolidated corporate tax base. It would make tax levels more comparable, and it would allow firms to file a single consolidated tax return for the EU, supporting the single market. And the third step would be a focus on harmonizing tax rates. Yes, some tax competition is healthy, but in the single market, it has to be within limits. So one should think of agreeing on a minimum floor for corporate taxation. And ideally, again, this would involve all EU countries. But if this were to be not feasible, again, the euro area could lead the way by deepening the fiscal union inside the currency area. Finally, on distribution. Here I also see a role for a fiscal union to play. Since we have witnessed several examples in recent years of multinationals arbitraging tax systems to pay less than their fair share to the society. We have witnessed the possibility for cross-border tax evasions from wealthy individuals. And a more cooperative approach to tax policy should counteract this and would be in the interest of all countries. And it also would be a timely reminder to citizens on how the Union can defend their interests. It goes without saying that there is too much diversity on the wider question of distribution for these to be answered at the European level currently. To sum up, a functioning banking union reduces the need for the stabilization function of a fiscal union, but not to zero, and greater efforts should be invested in the allocation and the distribution function. I'm going to conclude now, you can be patient. As I have laid out what I think could be a realistic vision for the euro area, which combines the 2 twin needs: diversity and cooperation. But for the euro area to prosper, We need a third element, responsibility. As we are all in one boat, every country has to pull its weight. Diversity is welcome, but it cannot be a shield against change. And having lived here in Milan for 2 years, I would not be as pessimistic as Barry Eichgreen, who in a recent essay wrote, I quote, "And the biggest problem is yet to come, namely in Italy, that is unable to grow, incapable of reforming, and burdened with what increasingly looks like an unsustainable debt." End of quote. Indeed, the euro area cannot prosper if the third largest economy has a potential growth rate around 0. Italy has to grow, and it will not happen by waiting for the cycle to turn. The challenges for the country are long-term and they are structural. Let's only take a look at the trend in growth rate. Real growth in Italy was 5% in the 50s. It was 4% in the 60s, 3% in the 70s, yes, 2% in the 80s, 1% in the 90s, 0 since 2000. And Italy is too big to be rescued from the outside. It has to make the turnaround on its own, and its fate will critically determine the fate of the euro area. In this sense, the future of the euro area will not be decided in Paris, not in Berlin, not in Brussels, not in Frankfurt. It will be decided in Rome. And because of my personal experience with this country, I neither worry for the future of this country nor for the future of the euro area. On the contrary, the vivid entrepreneurship in this country, its world-famous creativity, the power of its civil society and its citizens, educational systems with institutions like Bocconi, and now maybe the evolution of a new political system are promising. And I really hope that Italian citizens rally behind these efforts, because reforms will lead to growth. Growth leads to maintain a sustainable debt, and growth can be shared within the whole society. But as I said, the turnaround is in your hands, but your friends will be with you. Let me again thank you for the award given to me. I'm touched, I'm honored, and I promise to keep on working to build on our European house in the 21st century. Thank you very much.
Questo applauso è più che ben meritato da Joerg, che ha enunciato la sua lectio magistralis sull'area euro. Oserei dire una vera e propria call to action per tutti noi e come tale la ricorderemo.